Good morning, everyone, and welcome to a little explanation of our financial projection template, especially focused around how, as a startup, you should make your forecast to raise capital from investors, right? And a template like this applies to any kind of startup, really, from whenever you can make projections, so from very, very early stage till I would say IPO almost, really covering what I consider the state of the art of financial projections for fundraising and company sale. And we're gonna have this template on our website as well for free, of course. And you can find it by Googling Equidam Financial Projection Template. Be careful to search for the yearly one, as this is the one that I would suggest for fundraising. We also have a monthly one that works better maybe for budgeting. All right, so let's cover this template. What is it, right? It's a yearly projection template that is very simple, and its job is to be as clear and concise as possible to explain investors really the assumptions of the model and to allow people to play with the assumptions in order to be more confident with the results of the model, right? So we have a summary sheet that we'll cover at the end. We have a tab about revenue, a tab about costs, balance sheet, and cash flow assumptions, and then the Equidam financial inputs that we're also going to cover at the end. So that's it. That's the whole extent of the template. So if we start from revenue, so let's take the case of a startup like that is about to make their financial model and their financial projections for a fundraise. So here we have a few examples of different business models, right? So we have subscription, we have large recurring contracts that are kind of closed by the founders, we have e-commerce sales, and we have outbound sales. So of course, no startup has all of them, or maybe a few have all of them, but maybe they don't. So the idea here is to mix and match and pick what your specific company does and then delete the rest, right? So each of these chunks here is deletable. And then when deleted, you're just gonna have to adjust the totals and just give a glance to the model overall. So in the same way, like everything inside each of the model is deletable and can be adjusted, right? So in this case, we are looking at a subscription model that starts from paid advertising. So if your startup doesn't do paid advertising, you can remove this, or you can change this to, TV advertising, whatever your source of visits is. So in this case, the model goes from clicks and then organic visits to calculate a total number of visits, which then are converted at, in this case, a conversion rate of 1.2% in new subscribers. The specific company has 4 products. Again, this is an example, but it has 4 products. And so the new subscribers are configuring themselves into 4 different products, in this case at the same percentage, right? But this could be, okay, product 4 is only bought by a small percentage, whereas product 3 now has to go to 40%, right? So we keep the 100%. Again, very customizable. All the formulas are very easy. There's no complicated formula. So this is editable and auditable by anybody, right? With a very basic Excel knowledge. And there is no better way than Excel to do this, right? So we've seen over the years a number of software coming up and trying to replace Excel for financial projections. In my opinion, when you go fundraise, it's still best to have an Excel model that is understandable and that really conveys all the assumptions to potential investors or buyers. So again, here we have, in this case, we have a churn as part of the model. So we have active subscribers, which are then in the end the main variable to understand how many clients we have on each plan, and then how much each plan costs. This is going to determine the revenue for each plan, and then the total of that is going to be the total revenue, right? Again, this is like a sort of a guidepost, right, to allow editable and personalization of your plan, of your specific model. So large recurring contracts. So again, here is a case of we have new closed contracts every year. We have some churn, and then we have some active contracts. So the total of active contracts, which determines the revenue when multiplied by an average price. And then you get to the total revenue. E-commerce sales, we have, again, an assumption on traffic sources. So paid advertising, organic traffic. This determines the visits. A conversion rate determines conversions. And then we have some returning customers from the previous years. So this is our model for that. This determines total customers that for an average order value determines revenue. And then outbound sales, another fairly common model. We have a number of sales agents, which in this case starts actually from zero. But again, this is from the cost assumptions that we'll see in a second. And then we reach a certain number of prospects per week. That means that we reach a certain number of prospects per year, per agent. And then this is the total number of conversations started that at a certain conversion rate converts into new customers that with a churn determines a number of active contracts. And then when we multiply that for the average price, we get final sales revenue. Again, this is modifiable, right? Let's say that the price increases every year, right? Yearly price increase. We want to compensate for inflation, right? So that could be 5% per year, right? So then I would multiply this times 1 plus the yearly price increase, and then at the power of 1 plus the number of years, right? So the number of years that we have here. So then here we have a very simple price increase model, right? Where the price increase is 5% every year. So actually, I'm sure we have to do without the 1 plus, right? Yeah, exactly. So yeah, it's very customizable. You can really play with it and make it as minimal as possible, but still full of assumptions and clear and detailed, right? And let's see the cost. The cost is also very interesting. So we start with wages. Again, here, depending on what costs you want to see, you want to show to investors, you might want to adjust this, right? So for a company where inventory is pivotal, like you need to really make sure that you have the inventory in order to sell it, then maybe you want to start from inventory and your inventory assumptions. If the company relies heavily on its computing costs, like an AI company, you might want to start with your AI, with your computing cost estimations rather than wages. For a SaaS company where wages are, 80% of the expenses, you start with wages. So executives, we have a CEO, we have a CPO, a CTO. You can see here we can change pretty easily when they actually come. We could assume that we always have a CTO, so we could remove this from the model to make it simpler if we wanted to. So, and then we would just have to adjust the formulas. We have mid-management that is going to come in later on. We're only going to have mid-managers when there are more than 9 employees. So quite simple to adjust that model and to see the assumptions very clearly. We have technology development, product managers and developers. Sales, again, here you want to separate, instead of development engineers having front-end and back-end developers or having data scientists or what have you, right? It's as simple as copying this model and then inserting it, right? And then having like front-end engineers, right? And then connecting just so the sums are correct, right? So that's the flexibility of it. Sales and marketing, same story. So in this case, we have sales managers and we have marketing staff. Little bit of a different model here, where we have supplemental staff for marketing that we can adjust based on the strategy. So in this case, we see that we have a marketing person every 150,000 visits as our normal staff requirements. But then we have supplemental staff, almost 1 per year additional. And this might be because the strategy of the company is to open a new market every year or open a new product every year. And they want to have marketing people beforehand, right? Before it becomes like sort of maintenance staff, right? Operations and customer support. So of course, all the salaries, it's all random. It's gonna depend greatly on geography and level of seniority that the company requires and so on. Customer onboarding stuff, like again, the categories as well, right? And then finance and administration. a bit more general, used and needed everywhere. We have a total headcount. We can have additional personal expenses. In this case, we only have social security, but we have more personal expenses in SGA, so selling, general, and administrative. So here we have our advertising connected to the revenue, right? So we don't want to have assumptions on both sides. So in this case, the assumptions for the advertising are in revenue. We have additional advertising, just general maintenance, in this case, as an example, events and radio and TV. Our technology costs, servers, computers, computer equipment, and third-party development. And then we have banking and insurance and bank charges. And then professional services, legal service, accounting services. You could have more, right? Facilities and infrastructure, we have a rent, we have utilities, and then in this case we have some additional expenses for staff, like travel, partner program, supplies, and others, right? So this is like a general expense voice where we can just add a random well, not a random, but like, let's say there is uncertainty in these estimates, right? So we want to have an extra budget in case anything happens. In this case, it's set as 2% of sales, but maybe we want it to be 4%, we want it to be 1%, right? So we can change that. We have some depreciations, so that's where it gets a little bit more financial, but we are depreciating our technology for 5 years, right? So we spread the cost of our assets over a period of 5 years. And we have loans, which are going to be set actually in BS and CF in that tab. And then income tax, percentage of tax with the deferred tax assets so far. So this is a bit more financial, but it's also a lot more standard for pretty much every company in the world. Again, more financial, but still for that not difficult, and still it should not be difficult for you or investors to understand. We have the balance sheet part, right? So like these are assumptions about balance sheet and cash flows, which we need to have in order to get to cash flows for us, for the investors, and for the valuation as well. So we have account receivables, we have inventory. So account receivables are estimated as number of days of revenue. The idea here is that if your average invoice is 30 days, at the end of the year, you're going to have about 30 days worth of revenue that still needs to be cashed, right? That's the definition of a receivable. Inventory as a percentage of revenue. So let's say, like, again, you need to keep a percentage of your revenue as inventory to be ready to sell things, right? Especially physical products. For a software product, this could easily be 0, right? And we have intangible assets, tangible assets, financial assets. These are normally taken from your balance sheet, from your accountant, right? So and then again, if the company relies heavily on intangible assets, for example, like let's say it's a crypto company that has NFTs, right? And the value of those NFTs is actually very important and needs to be specified. You can expand this model, right? And really have, so this Excel is really like a backbone for almost any model. Expand out the intangible assets to show how the NFT value increases over time and things like that. Cash, of course, starting amount of cash, how much cash is in the bank. Liabilities, we have on the liability side of the balance sheet, we have account payables, the same story of the receivables, but reverse. So how many invoices did you receive that you still have to pay on the 31st of December? And then long-term liabilities, in this case, we have a basic first loan here, but we could expand this, right? According to the specific situation of the company. Equity fundraising as well. So fundraising, money that comes in, distribution, money that goes out. And then capital expenditures. So, and again, there are companies here that are incredibly reliant on capital expenditures. Think about asset heavy companies like a recycling plant, right? So in which case the capital expenditure should be expanded, should be justified, should be a bigger model, and should probably be first as well, right? So again, this model allows you to do that. Everything is packaged nicely and cleanly in the P&L and CF. So this is just like a summary, right, of everything else, where investors can really check things. And then here, importantly, we want to really show the past year as well, right? So if we show that, for example, here, executives were only 1,000 euros last year and they are going to be 100,000 euros, we're going to get a question, right? And that's okay. That's a fair question. And maybe this was the case, right? But the past really helps understanding the future. So if we're coming into 300K in revenue from subscriptions in year one, and like we are at 250 in year zero, right? Like this is going to have like a certain way of reading it from investors compared to like starting from zero, right? Or like that's the power of traction. So we want to really make sure that these numbers are filled in, and again, it gives also a picture of the current status of the company on top of the projected status. For the cash flow, this is less important. So in that case, we only look at the future, and we need to have the cash flow for the valuation as well. So for the valuation, we have a simple Equidam financial input, which is all connected to the rest of the sheet. And so this means that when you upload this on Equidam, all the numbers are reflected properly from your financial projection template to the Equidam financial projections. So that concludes the story. So who should use this? Like, in my opinion, everybody. The basic financial modeling that you need for this is almost in my opinion, the required level for every founder. Or if you really don't have this proclivity or this knowledge, somebody in the funding team or the CFO should easily be able to go through this model and to customize it to their needs. And this means that you don't have an extremely complicated but general model that you can download online in other places, but you have a little bit more work to do in terms of modeling, but the outcome, in my opinion, is extremely worth it. Is extremely worth the extra work, because it's going to be clean, it's going to be specific to your company, and it's going to be useful for investors, but it's also going to be very useful for you to understand, okay, which are the levers that really affect my financial projections, what can I really play with, and also to set budgets, broadly speaking, budgets for each of your expenses, right? For example, how many, like headcount, right? Headcount is huge and a big expense, and it should be modeled properly. For specific budgeting, right? When you are looking at how long is my cash gonna last, which in startups is, as you probably know, a very important question, then maybe the monthly projection or quarterly projection is more useful, and it can be a lot more detailed. And it also allows you to forecast and then come in with the actual numbers and fill them in, right? This is not meant to be updated very often. This is meant to be done once when you are either fundraising or selling the company, and then adjusted based on feedback, but it's not meant to be updated every month, just because updating it takes coordination between all the functions. You need to understand with sales if the projections are realistic, with marketing if the goals are realistic, with development how many people they need, right? So updating this normally happens around a funding round or a company transaction. So that's it. I hope you like this template. And yeah, if you have any questions or comments about it, let us know. And we are more than happy to try to improve it even further, and really, just keep on updating it and keeping it the state of the art of financial projections.